Can a company's share price tell you if the stock is cheap or expensive? Hey guys, this is John from 𝐒𝐃𝐃 bro. Welcome back to my channel. Today I'll be talking about the difference between share price and market capitalization, the formula of market cap, and some of the real life examples. Before we start, gently hit the like button for the YouTube algorithm, subscribe to this channel if you haven't already, and click on the notification bell so that YouTube will notify you whenever I release a video. Imagine that you are buying a house for 500,000 ringgit, and let's assume that you don't have the capability of paying the full payment in cash. Let's just say that you decided to get a loan for it, and let's say you are able to get a 90% loan from the bank. So that means that you will need to pay the remaining 10% out of your pocket, right? Which is about 50,000 ringgit. So does that mean that you can only enjoy 10% of the house land area, since technically you paid only 10% of it? The obvious answer is no, right? Of course, you'll be enjoying the entire space of the house. So it's the same as buying shares. When you buy a company's share, this will automatically make you a partial owner of the entire company, which means you are not just buying a piece of worthless paper, but in fact, you are investing in the company's entire business. This leads to my next point, where a company should be valued as a whole, and it's based on its market cap, not by its share price. And fun fact, do you know that Nestle is actually cheaper than Maybank? Huh? Why leh? Well, if you base on their share price, it wouldn't make sense. But if you value the company as a whole, or so to say the market cap, things may look a little bit different. Before I continue, please do note that none of the listed stocks are a recommendation of buy or sell. Yeah, I'm just using these stocks as an example to explain about market cap. Alright, so to calculate the market cap of a company, just take the number of shares that the company had issued, or what we call the outstanding shares, and multiply it by the current market price of the stock. In the case for Nestle and Maybank, this is what their market cap will look like. As of 30th of January, Nestle is trading at the share price of 137 ringgit per share, and it has an outstanding shares of 234.5 million. So if we take these two figures and you multiply it together, you will get the market cap of Nestle, which is roughly about 32.1 billion ringgit. On the other hand, Maybank is trading at 7 ringgit and 81 ringgit per share, which gives you the impression that the share price is cheaper than Nestle, right? However, you need to take note of this, which is the number of outstanding shares that Maybank has. It is 48 times more than Nestle, which is roughly about 11.4 billion shares. If you take these two figures, 7 ringgit 81 cent, you times 11.4 billion, you get the market cap for Maybank of 89.1 billion ringgit. So if you compare both of these companies, Nestle is in fact 2.7 times cheaper than Maybank when we look at their business as a whole. Now that you have the general idea of market cap, do note that this is only effective if you are comparing companies that are in the same industry. So it's basically like doing an apple to apple comparison, and it's not an orange to apple comparison. For example, let's just say that we have two company A and B, and both of them are selling chicken rice. Alright, so this means that they are in the food and beverage industry. And let's assume that company A's share price is trading at 10 ringgit per share, and its market cap is worth 20 million ringgit. On the other hand, company B's share price is trading at 20 ringgit per share, and its market cap is worth about 10 million ringgit. And let's just assume that they are making the same amount of profit, which is about 2 million ringgit per year. Alright, so if you were given the opportunity to buy either of these companies, which one would you choose? company A or B? Most likely you will choose to invest in company B, right? That's because you are paying at a cheaper valuation. How so? Although company A's share price might look affordable when comparing with company B, but when we value the business as a whole and the amount of profit that they are making, you will notice that company B's valuation is actually 2 times cheaper than company A. To sum it up, the market cap shows the market value of a company. As an investor, it is important for you to look at the bigger picture by not judging a company's value by its share price, but as a whole business. However, you should not rely on just one financial metric when valuing a company's worth. There are others that you should consider as well, like understanding their competitive advantage, or what we call it as moats, the financial ratios like, for example, price to earning ratio, price to book ratio, etc. Their financial statements and so on. So we have come to the end of this video. Hope you guys enjoyed the content, and if you did, make sure to like this video, share it to your friends and family, and subscribe if you haven't already. Also, follow my Facebook page. I post pretty much daily, so if you want to keep yourself updated about the market, and most importantly, if you love memes, do follow it. Link in the description down below. Thanks for watching, and I'll see you on the next one.